Hey dividend investors, today we are going to be looking at the ETF from BMO called ZSP. It is the BMO S&P 500 ETF. This one is in Canadian dollars. It is traded on the TSX. Let's get down, let's check it out, let's see what it holds, and let's see if it's a good fit for your investment portfolio. I have personally invested in this ETF myself, so just keep that in mind. I may be jaded. Let's go see. Okay, so at the time of making this video, it is currently being traded at $53.35 per share. From there, what we want to look at is quite a few different things. We do notice that it has been around for a while. Its inception date was 2012. You might as well say 2013 if you want to round off. Its expense ratio is extremely low. It is 0.08%. So that is like basically nothing. It's like 8 cents per $100 that you put in. From there, what we want to look at is the dividend, because of course I am myself a dividend investor, and it is 1.46% yield, which is pretty good considering that it's an index ETF. I sometimes like index ETFs for their growth and their stability, but let's go really check out what this one has. But really quickly, average volume is not too bad. It's 290,000 shares traded every single day. The other day, it was traded at 1.5 million shares, so it was quite a busy day for this ETF. Now, why is this important? I have mentioned this in a few other videos, but if you are looking to get in and out of an ETF quickly with a lot of shares, you would want to have a lot of volume. Otherwise, if you're only looking at 1,000 shares average per day as an example, and you wanted to trade 1,000 shares, you may have an issue trying to get out of that trade. But when you're talking about millions of shares, most people probably won't be spending millions and millions of dollars on a single purchase of an ETF. So you are all set there. Now, this is what's gotten me excited about this ETF and why I really like it. So I did invest in it roughly right about there myself. So I've been in it for a bit of time and I have seen some growth. Now, this ETF has ridiculous growth. Of course, it's an index fund, so you're generally wanting to see roughly around 10%-ish per year or more if you bought it there, if you were one of the lucky few. What do we notice when it comes with indexes? Well, we notice that there's usually some pretty good growth. Obviously, some downturns here and there. There's always that happening. And then you'll see sometimes where an index will just trade sideways. When this is happening, that's usually a fantastic time to get in if you're looking for a long-term investment. And then you'll see some growth once again. Now, when the growth starts happening, it happens with obviously some dips and valleys in between. Some small little dips. You're generally going to see dips, usually one dip every single quarter. That's just how indexes work. So what you would want to do, and what I personally like to do with random indexes or even with stocks in general, I never want to buy them at the high. What I like to do is being able to just set money aside, and I know there's people who say never save money. Well, I like to save money to make investments, and I never want to get in when, let's say, a stock is at an all-time high of $40 because it's going to dip probably in 2 weeks to maybe $37, and depending on how much money I have, that might get me one extra share, things like that. And that is why I always hate to buy at the top. So that's why I always stick money into a savings account, get no interest basically, and then maybe a 1 month, 2 months down the road, there's a little bit of a pullback, buy in, keep on going, and that's my investment strategy. And that's no different from a random ETF to an index ETF to a random stock. It doesn't matter. That is basically how I work. And I did that again roughly around that dip right there. And I thought it would actually try a trade sideways for a bit because we've seen two small dips, and of course the W always means that it's going to go up. But I personally thought, hey, it's just going to trade sideways for a bit. We don't know. It's going to be a long road to recovery because of COVID. But again, I was wrong. And you can never, again, trust any random person on the internet, and that is why. Because, of course, we've seen something that I didn't think was going to happen. But as we can see from the beginning, we can basically look at back in 2014, this was being traded at roughly $22 per share, $20 to $22 per share. From there, all the way to now, 7 years later, 7 years later, we are now at $53. We have more than doubled over the past 7 years. That is a fantastic return. And as we can see, the portfolio strategy here is the BMO S&P 500 Index ETF has been designed to replicate to the extent possible the performance of the S&P 500 Index. Net of expenses, the ETF invests in and holds the constituent securities of the index in the same proportion as they are reflected in the index. Now, what is held in this ETF? Well, it's exactly what you would think. You're going to be getting Apple, Microsoft, Amazon, Facebook, Alphabet. Isn't it kind of interesting how, like, basically the top part of the index is all tech stocks? Remember how we never thought this would happen? Way back when we had that .com crash? Nobody would have thought that there would be a massive tech influence on a major market. So that other than the Nasdaq, so nobody would have ever thought that was going to happen. We have Berkshire Hathaway, which is an investment company in my opinion. J.P. Morgan, which is a bank. I love banks. And of course, Johnson & Johnson. They have that vaccine coming out. More and more countries are going to be using a Johnson & Johnson vaccine, which I'm going to say that is going to be rising like crazy. Berkshire Hathaway has Warren Buffett reinvesting in that company by buying back their shares. JP Morgan Chase is a bank. I like banks. Tesla is going to the moon. Google has YouTube. That is the future, as we can see in this video. Facebook, I'm kind of iffy on Facebook. They're kind of wonky when it comes to their new terms of service, when it comes to different elections and things, and what they did in the last election kind of ticked a lot of people off. So I'm not a big fan of them anymore, but I used to hold their stock from $30 or $40. I bought more at $30, I bought more at $20, and then I sold it all roughly around $70. Kind of wish I still had their stock slightly, but Microsoft is another killer, and Apple is just printing money in a sense. So I think that this is a pretty solid ETF. Now, that is my take on this ETF. Is it good for your investment portfolio? Well, if you're looking for growth and something that can mirror the market, or at least a part of your portfolio to have that, getting not as high of dividends as you would think. This one does pay dividends every quarter, but it is giving you at least that 1.5%, which is currently higher than interest, and you have some underlying growth. So what I would look at this is if you are in that 20 to 30 to 40-ish range, and you're looking for something for a retirement, which may be 20, 30, 40 years down the road, then this could be a great hold to have during that whole entire time. Stick 10 grand into it, let it sit there. If you can reinvest the dividends. But again, I personally don't use that strategy, and I'm going to make a video soon about why I don't reinvest my dividends. I technically do, but I don't. You'll have to watch that for that video. Anyways, I'll see you guys in my next video.